Welcome back to Milkshakes Markets and Madness. And over the last month, madness has definitely been the operative word. Now, during that time, we've seen lots of market volatility as Trump's policies have finally, shockingly, brought the world to be aware that he actually was serious about what he intended to do. And as a result, as the volatility has spread, we have seen foreigners sell their U.S. assets and then sell those U.S. dollars and repatriate that capital back home. And as we have thus seen, U.S. asset prices have fallen, the U.S. dollar has fallen, the foreign currencies have rallied, and as such, the milkshake has been invalidated, the U.S. dollar is done, and it really is different this time. The only problem with this narrative is it's not different this time. This has happened several other times, two of them very specific that I'm going to go over today. But this is actually helping me explain the dynamics of the dollar and the dynamics of the milkshake. And here's the funny thing. Everybody is telling me that foreigners and foreign institutions are selling their US dollar assets and sending them back. And as a result, the milkshake was never correct. But I then turn around and say, how is it possible that foreigners and foreign institutions could be selling their US dollar assets and then causing the US dollar to fall if the US had not sucked up all their capital in the first place? And how could the dollar fall if it hadn't risen in the first place? And that is what we're going to go over today. Because when you think about the dynamics, this helps explain what is going on, and it helps explain the theory, and it helps explain why I don't think it's different this time. Maybe it will be. We always have to allow the possibility of being incorrect. But so far, this is actually playing out just like the times before. And so what I thought we would do today is walk through some previous examples, and you can decide for yourself whether you think it's different this time or not. So let's get started here. Let's pull up now this is a chart of risk assets, a number of risk assets from around the world. And it goes, this is basically the last 6 weeks, let's call it, or the last month. Now, as you can, the white line is the dollar. And all of the other lines are just various equity indices around the world, as well as risk assets from around the world. And you can see going into the first week of April, we had a big sell-off. Now, the last week to 10 days, things have somewhat stabilized. They've bounced a little bit. We've talked about that over the last couple of weeks on the shows over the last couple of weeks. But this move right here, the white line is the dollar. This is the one that has everybody saying it's different this time because it fell almost 5% over a 2-week period. And as a result, everybody is losing their minds. But let's go ahead and let's look and see. This is a chart from 2008. Now, I don't know if anybody remembers 2008, but there was a little event in 2008 called the global financial crisis. And it really got crazy in the fall of 2008. Now, this is the DXY. This is the dollar index. And on September 15th, 2008, it was at 80. And 2 weeks later, it was at 76. So I'm not a genius at math, but my calculations tell me that that's about a 5% drawdown. And that after that, we saw it go a lot higher. Now, what happened in the equity markets during that same time period? Well, let's look here. This is those risk assets over that same time period. Well, you can see as markets initially started to sell off, this is when the dollar was falling, right? And then after that, after the dollar fell, when things got more serious and they continued lower, that's when the dollar rose and went up. And as markets crashed into the end of the year, the dollar went higher. But the initial move was the dollar falling. The reason the initial move was the dollar falling is because when things start to get bad in the United States and overseas, what do you have to do? You have to reach into your rainy day fund. Well, the United States is the primary location where the rest of the world invests, and we are the world's piggy bank. We suck the milkshake up into the world piggy bank, which is the United States markets. And when things get bad, the foreigners started selling. And as market prices went down, they repatriated that capital and the dollar initially fell. But when things got really bad, then the dollar carry trade kicked in and the global leverage started to get unwound and the dollar rallied. Okay. Then let's look at 2020. Everybody remember 2020? It was a little bit of a big deal. And in February of 2020, markets had been going, kind of sideways, started to get crazy. And then they started going down in the last couple of weeks of February. Okay. And in the last couple of weeks of February into early March, what did the dollar do? Well, again, I'm not a genius at math, but this is the wrong dollar index. Hold on. Here we go. In early 2020, and in February 20th, the DXY was at 99. And 2 weeks later, it was at 94. That's about a 5% drawdown. Now let's look. Okay, let's go back to 2008. 5% drawdown, reversal higher. 2020, 5% drawdown, reversal higher. When things get serious, that's when the dollar rallies. And so from here to here, the dollar fell as markets initially sold off. That's foreigners selling their U.S. assets, selling their dollars, repatriating their capital back to their home market. But then when it gets really serious, that's when everybody scrambles for dollars because they all have dollar debt and they all need dollars to operate on the global stage. And that's why you saw this rally after the initial sell-off. Now, here we are again today. All right. So over the last 2 or 3 weeks, we've seen the dollar fall 5%. Now, again, this is not new. Happened in 2008, happened in 2020, and it's happening again right now. Now, what comes next? I don't know for sure. I just know that this is normally how things go when you have a global event. The rest of the globe has to tap into their piggy bank. And again, the piggy bank is US dollar and US assets. So they sell that and they repatriate it. But let's look and see at what asset prices did over the last couple of weeks. Again, we saw those fall as the dollar fell. Now, so far, things have stabilized. Maybe the worst is behind us. Maybe things will get better. Maybe Trump will relent, and maybe the dollar will continue to fall. Maybe they will come out and do QE again. And just like every other time that they have done QE in the past, all the dollar bears and all the US fatalists will come out and say, see, it really is different this time. It's all over for the US. It's all over for the US dollar. Get ready because this is it. But there's a problem with that as well. Let's just go back to 2008, all the way back to 2008. And the reason we're going to start, now we could actually go back to 2000 or 1990, but the reason we're going to go to 2008 is 2008 was when the extraordinary monetary policy really started to change. Rather than just cutting rates and easing, the world started doing extraordinary monetary policies such as QE, stimulus, the total bailouts. Now, it had happened to a certain extent in Japan prior to 2008, but 2008 was when the whole world kind of adopted these quantitative easing policies, these dramatic bailouts, the dramatic stimulus plans, the whatever it takes moments. So if we go back to 2008, and we look and see what happened has since then. This chart right here pretty much explains the whole concept of the milkshake. And I'm going to walk through and explain why. But what I want to point out is that the whole concept of the milkshake is that the dollar will outperform other currencies, and that US markets will outperform other world markets. That's really what it says. And then it says, ultimately, we will have a crisis. The dollar will get too strong, and they will have to ultimately do some kind of a global reset or recalibration of the monetary system. And at that point, perhaps maybe the dollar loses its global reserve currency status or whatever it is. But until then, this chart does a very good job of explaining the overall concept. And this is why. If we look back to when the extraordinary monetary policies start, and we just zoom out and don't focus in on the details like we just did over the last couple minutes, but just look at the big picture. The blue line is the S&P 500. It has dramatically, it's gone up 350% over that time period, and it has dramatically outperformed the rest of the world. It's just right here. This is the data. Okay? And over that time period, the dollar went up 30%, 29%. So this is what I say, well, the DXY does not have to fall for US asset prices to rise because it's a relative gain. Okay, so that's the first thing. So now, what else does this chart show that helps understand the overall thesis? And basically, it basically really explains the structure of the monetary system. Okay, so this is the same chart, but this time I have put 4 different periods on here, these highlighted periods. Now, what are these events? Well, 2008, that's the global financial crisis. 2011-12, that's the crisis in Europe, the European sovereign crisis. And and then that's also, and then in 2015 and 16, this is more problems in Japan and Europe. In 2020, this is COVID. And then I didn't put anything at the very end here, but I could potentially, we'll have to wait and see what happens, put another one of these highlighted areas right here. Because what is going on in these highlighted areas? So the milkshake concept came up with the idea that we would enter a sovereign debt crisis. And the reason we would enter a sovereign debt crisis is because all the previous crises had either happened on the corporate balance sheets and the bank balance sheets, but through the series of bailouts and QE and monetary policies, all of the problems had migrated up to the country balance sheets, either the country balance sheets, the central bank balance sheets. It was now a country problem as opposed to necessarily just a corporate problem or a banking system problem. And in a sovereign debt crisis, what happens? Interest rates rise, sovereign bonds are rejected, and you get countries in crisis rather than just companies or banks in crisis. So if we look back, and how do they respond? How do governments and monetary authorities, how have they historically responded to these crises? They have responded by injecting a ton of liquidity into the market. That is what I always called the milkshake. That is the world or a country or an individual nation injecting liquidity and creating this milkshake. And then the idea was that it doesn't really matter who creates the milkshake. What matters is who drinks it, who sucks it up, who gets it, who captures it. And so let's go back to 2008. This is the whole world mixing the milkshake via stimulus, bailouts, and quantitative easing in the midst of the global financial crisis. And after that, the blue line over the next 3 or 4 years outperformed the rest of the world. And the dollar kind of went sideways, even though they're doing QE. And even though they're trying to weaken the dollar, it basically went sideways, down just slightly. So that period, so then we get to the next one. This is the euro area crisis. And it's when the US did QE2, Europe implemented more policies in Europe, quantitative easing policies, and Japan doubled down on everything they were already doing as well. So this is the second period of time where the US mixed, or the world mixed, a new milkshake. And what happened over that time period? The US outperformed again. Everybody else did okay, but the US dramatically outperformed again. And what happened during that time period? The DXY rose. Okay. It went up, despite the fact they're doing QE, despite the fact that, all these bailouts and stuff were still taking place, the dollar rose. Part of the reason it rose is the US stopped doing QE right around here, and the rest of the world continued doing it. And in the second half of 2014, the dollar went on one of its biggest runs in history. I think it was up 10 or 15% in a 6-month period. And despite the DXY going higher, so did the S&P 500. Now, then we get into 2015 and 16. This is when Europe and Japan come out with more. The US was no longer doing it. And I think they were starting to sell bonds during quantitative tightening. I can't remember for sure. But this is where another period where Japan and Europe mixed the milkshake. But again, it doesn't matter who mixes it. What matters is who captures it. So then what happened over the next 5 years? The dollar pretty much went sideways, and the US captured all of this. And then we get into 2020. Everybody mixes the milkshake again. And what happens after that? The dollar goes sideways to higher. I mean, the dollar right now is basically where it was during COVID, right? Despite all the bailouts, despite all the stimulus, despite all the quantitative easing and all the blog posts written about the death of America, it went sideways. So now let's look at these other time periods. So the light blue, this is when the world is mixing the milkshake. The green areas is when the US drinks it. So you got them mixing the milkshake, the US drinking the milkshake. The world mixes the milkshake, the US drinks the milkshake. Europe and Japan make the milkshake, the US drinks the milkshake. The whole world makes the milkshake, the US drinks the milkshake. Now, we're at a pretty interesting time period again. The last few times that we've seen this type of price action in markets, we get another mixing of the milkshake. And that's probably what we're going to get this time. And if that happens, maybe initially the dollar falls a little bit. But just like the last several times, it will eventually recover because it has to. unless they redesign the system, which maybe they will have to do, the dollar will eventually rise again. And the reason is because of the design of the monetary system. The way that and it's the reason the dollar has risen over this 20-year period, despite 30%, despite all the stimulus, all the bailouts, and all the money printing. Because the way you provide short-term liquidity of dollars to the system is the same process that increases medium and long-term demand. In other words, because of our debt-based monetary system, the way new capital is injected is by loans. They loan it into existence. And so that provides short-term liquidity. It relieves some of the pressure, and asset prices can rise and the dollar can fall. But eventually, all that does is increase the overall big pile of debt. And eventually that matters. And when it starts to matter, the dollar starts to rise again. It's just the way it works. The debt created by providing liquidity is demand for future dollars. And when you hit that future, demand is there, market goes higher, or the dollar goes higher. Now, can it be different this time? Sure. Maybe they're going to come out with something new. Maybe they will do a total global reset. The dollar will be reset to 50 cents on the dollar. Maybe they'll back it with gold. Maybe they'll back it with Bitcoin. All of these other, theories that are out there. Perhaps that will happen. But that's not what's happened historically. And that's not what I'm going to bet. I'm betting it's not different this time. Maybe it'll be different for a few months, maybe even for a year. But until they redesign the structure of the system, this pattern will continue to play out. So anyway, I'm going to leave it at that this week. A little bit shorter than the last couple of weeks. I think I ran pretty long the last couple of weeks. But this chart, in my opinion, pretty much explains the whole dynamics of the system. And this is where we're at right now. I just thought I would just show this again. This is since 2020. And the reason I'm showing this is because gold hit an all-time high again. And listen, you guys have heard me say this a million times. All of you should own gold. It should be the cornerstone of your portfolio. The Milkshake, in its very first time I ever mentioned it, I said gold would be the ultimate winner and everybody should buy gold, and gold's going to $5,000. But since COVID, since the beginning of COVID, markets, stock markets in the US, despite the hard sell-off in the last month, have still outperformed gold since COVID. Now, if you take it all the way back to, I think, 2000, actually, let's just do it. I'm pretty sure gold has now outperformed stocks over the, oh, hold on. Jeez. I'm pretty sure gold has now outperformed stocks over the last 25 years. But the point is, everybody should own gold, but you shouldn't just own gold. Yeah, see, yeah, gold has dramatically outperformed stocks. And this, so the point I want to make is everybody should absolutely own gold, but I don't think everybody should own just gold. If you have a 20-year time period and you don't have to worry about liquidity in the short term, then sure, you can have a higher allocation to gold. But if anybody out there is on some kind of a fixed income or in retirement and they need their portfolio to provide income to them and they need to draw on it, then you shouldn't have your whole portfolio in gold. But you know what we should also look at while I'm thinking of it. Hold on. We should look and see what the so over the last week, so this shows the last week, we don't really get an update on the COT report, but you can see gold here went to its all-time high again over the last, oh, you know what? I wonder if they even released yesterday because it was a holiday. These reports might be delayed a week, but we need to take a look and see as gold has surged higher, whether the commercials have continued to cover or whether they have increased their short. So it's going to be interesting to see what happens there over the next few days or over the next few weeks. Any case, this I hope has helped explain the overall structure of why I think things will continue. But it's going to be interesting. I personally don't think that we've seen the worst of the volatility yet. Or maybe we've seen the worst of the volatility, but I think we're going to see more volatility, and I think we're likely to see more downside in markets. And maybe that increased downside will then lead to another mixing of the milkshake. So anyway, that's it for this week. I hope you guys all have a great Easter and look forward to catching up with you next time. All right, bye-bye.